Hey guys, what is up? There's Mark. I knew you'd be here. I got in the room at first and you weren't there, so I thought maybe I was early, and I was. I was 40 seconds early. But you are indeed there. All right. Well, we can continue some of this wonderful stuff we're talking about in Discord on here. Let's check the market and do business first. But we have all kinds of interesting conversations going on in Discord about the lightning spread. Okay, now update on the back tester. I talked to tech support. I chatted with tech support. They had me clear my cache and use incognito mode to see if that worked. And incognito mode works for the back tester. Still doesn't work in normal mode, but then I think I closed the window by accident. I couldn't find the window anymore. I now looked. I did close it by accident. So I'm going to have to text it back to find the permanent fix. But for right now, I'm happy it's a clam because I have it working in incognito mode. I know that Tom was also having the same problem as me, but I suspect there may be other people. Whenever I was trying to do the back tester for the past week, it just said server error and gave me some kind of nasty message. Well, go try, clean your cache and get in incognito mode if you're desperate to run a back test and you want to check something. And I left this window up right here because we're going to talk about that. So, but we'll do that. We're going to do business before pleasure. So let's get over here to the market. Man, look at this freaking melt up. You got to love this. See that big blue gap right there? And it was never challenged. I guess in the second time period, it got in there a little bit. Well, okay. So the only thing more bullish than one gap is two gaps. And remember, this gap was a follow-up from this gap, which also held and was really a follow-up from this gap. I'm trying to say when you start seeing gaps, that's the direction the market's. You see multiple gaps. You guys know that. But I mean, the same thing on the way down. You know, we had a gigantic couple and then another one. So even if once you have a couple of those, even if you rally, it's going to sell off again, or that's what you suspect. It just helps me get on the opposite side of the trade. And I also look at the term structure from the volatility futures, like we talked about the other day. So let's look at that term structure from the volatility futures right now. So we'll do a little 3-month VIX divided by 1-month VIX. Okay, below the lines, below 1 is bad. Below 1 is bad. Even getting close to 1. Below 103 is bad. Anyway, whenever we're up here, and right now, just for reference, we're at 117. We're so far above bad. Not that it can't go back there fast if you get a volatility event. But also, we just got a bull cross on this ratio. Okay, well, let's see what happened the last time we got a bull cross. Let's see if the bull crosses are good signals. Remember, a bull cross on the ratio is bullish for the market. So the last time we got one, it was on that day. So no, not really particularly. You would have bought 600. And by the time it gave you the bear cross, you would have sold 587. So that was a loser or a whipsaw. That was a loser or a whipsaw. However, the following signal worked out pretty good because you would have sold 587. And you would have covered somewhere down here. But anyway, all right. Well, let's look at some other stuff. What else is moving? Qs look better than the ES today. Bitcoin's up 20 bips. Let's shut this bottom window. 10 years at 4.25. I mean, that's good. You could also use the 10-year being red, like it is, crossing it, doing a bearish cross, like right here as a risk-on signal. Let's see if that worked better than the last one. Okay, so bearish cross on interest rates, which is bullish for the market. So this got you bullish at 544. Anyway, that was not a great signal. But except it's not a great signal. But it did get the trend did go up, and by the time it reversed, that signal, the bond sell signal would have been awesome on December 10th, which happens to be the same day I invested in the model portfolio. Pretty close to the highs. I mean, we got a little bit higher in February, but well, that's on the 10-year. It was on the highs of the SPY. All right. Well, let's get into some other stuff. Let's look at some buffer reports, or maybe did anyone do that Micron trade? If you did, take it off. I mean, let's go look at it if you can. If you are able to, and the reason I say that, just from a game theory perspective, earnings trade Micron, 166 right now. So from a game theory perspective, you have a choice here, but it's so far away from any type of bonus time. It's 11% for bonus time. It's 1, 2, 3, probably no telling how many, probably 4 or 5 standard deviations away. Not going to happen. It's going to happen 1 in every 1,000 times or something. So at this point, you just have risk because the market could drop. And then you could I hate to turn a winning trade into a losing trade. The most you can make on this trade is 164 at expiration. Right now, it's worth more than that. So, I would take it off. You've made your money. And if you leave it on, you're risking some kind of black swan on the downside. But if that's all right with you, and that's just the chance you want to take, you could leave it on and hope for a black swan on the upside or something. But take that one off. Sorry, it wasn't a bigger one, but it was 15% or something. If you could just make 15% every week, and compound it, you'd be pretty well off, right? If you could make 15% every month, if you could make 15% every 6 months, you'd be well off. 30% a year, you double your money in 2.5 years. So, I take that. All right. So play for higher prices. Now let me show you the game theory on this one. So on this one, we're just pretending, of course, but the first option we bought it to, and I didn't really sell it. I just excluded it. But somewhere around 4, when we're up a couple hundred, I said, we're out. So we put 100 in our pocket. It was the idea, and we just risked 100 on this trade. Yeah, and the cost basis on this trade is 105. So this trade's free. This trade's free. Even you can look at this trade as being free, even if the market goes to 0. This trade's free. Now, hopefully, here's the game theory on this. You don't want it to go up. You don't want to turn a winner into a loser. You don't want this to go up and tag 2 and then come back down. As soon as it hits 2, you can put on another free trade. You can put more money in your pocket, right? So what you want to do on this is have a limit order in. If you only bought it for 1, put a limit order in for 210. As soon as you put it in, good till canceled. If it hits it, that's great. Then as soon as you get your notice, you have to, if you want to keep it going, you need to go out another. You could even go out in time the next time maybe, but you don't have to. You can also just stay on the first. There's lots of months we do get end of quarter markup, window dressing, whatever you want to call it. It doesn't mean it's going to happen this one, but we have a free roll at it. This is a free shot because of that, because we did well on the first one. So we're just trying to leverage our good luck, good fortune, skill, whatever from the first one into the second one, and try to keep this going. So hopefully this can hit 2 and we can do it another couple of times. What I do is after I do it the third time, I quit taking money out. I'll just let it compound. But the first couple of times I put money in my pocket because that's where you're going to lose. How many times have you won 1 and then lost 2, or 1, 2 and then lost 1, but gave all your money back on the 1 you lost from the 2 you gained? A lot of it comes down to money management and game theory and stuff. So if you have this one on, get your limit at 2 and hope it gets hit. If it doesn't, no big deal. You try the next one. It's a free shot, right? All right. So let's look at the model portfolio. Now, this thing's been jacked up actually, I take that back. Well, yeah, it has been jacked up. So I took it down off the website. If you're at the website, it's not working right now. But let's try to look at this. Let's try to look. USOY. So this is the latest one. Oh, yeah, it says 0, but my TastyTrade said 0 too. I just don't understand. Anyway, it's fine. I just don't understand how I'm at 0 I mean, with freaking ULTYs being up 37 bips. Let's look at this. This got to be sent wrong. X96 through X112. Yeah, happens all the time. Only to me, though, not to other people. All right, well, now I shouldn't have taken it down. If I would have just made that correction, now it would be right. I'm up 67 basis points. Benchmark's up 82 basis points, and that's something I'm happy with. The way I trade, I'm hoping to get a half to 3/4 of the upside. Because I have some hedging stuff in there, but I'm hoping to do a lot better on the downside. So yeah, I'd definitely take that. That's like 70% of the upside. All right. Well, what else do you want to look at? Let's look at the GPTY verse and the buffer report, and then we'll see what you guys have to say. Now, I just saw this one open somewhere. My computer's like that card game where you have to remember where the cards are. You flip over. It's the same thing as my computer. GPTY verse. There it is, my favorite little report. The index buffer report. It doesn't get much better than index buffer report, and it doesn't get much better than SFAL today. Look at that. Would you take a look at that freaking SFAL? So this is the point where we would go to the high yield database and look at that auxiliary database and click on the top 10 trades without having to go to the top 10 positions, without having to go to FinViz or anything. But I don't have that functionality working yet, but we're about to do a lot better here as far as data goes and stuff like that. I almost got it done last night, but I got frustrated and tired, and it was late, and I just put a pin in it. But I'm going to finish it today. Anyway, all right, look at this. T-SPY looking really nice. 5E looking really nice also. Now, I would expect that from 5E. Big updates should be good on 5E because they have 40% of their portfolios comprised of the underlying stocks. So 40% of their portfolio is totally uncapped. So especially relative to feet, I would expect 5E to get 40% more upside. Well, look, how much more upside would you say that is? In this case, it's about double the upside, but I'm just saying on average about 40% more upside. Look at this. KQQQ looks good. I don't think KQQQ is in the index buffer or is in the high yield database, is it? I need to check on that. Every time I see that, I think that it may not be in this T-SPY in there. I think T-SPY is, but I don't think KQQQ is. Well, we'll look at that in a second. Anyway, you can see most everything's doing pretty well. Look at ULTY making 41 bips. That's just awesome. Okay, I have other stuff to talk about, but it's boring. So let's see what you guys have to say. Well, let's look at the yield max buffer report. Speaking of boring, I mean, they're all up. They all seem to be up about 3/4 of the parent today. Look, that's about 3/4. That's a 3/4. That's 3/4 close. That's more like 2/3. It's more like 80%. That's 2/3. That's who knows. Anyway, lots of upside, not much outperformance unless your name is OARC, who is throttling the parent. And Misty is as well. Only one leading on the downside is PP. All right, now I'm going to see what you guys are up to. But like I say, I have more stuff to talk about. It's not boring, but it's more technical, so I don't want to lose people. So let's see what's going on. Yeah, 15% a week is good money. I don't care what you say. 15% a week is good money. How about, like I say, 15% every 2 weeks is great money. 15% at all. It's 15% every year is great money on your whole portfolio. Because then your whole portfolio is more conservative on your entire picture. But I'm happy with less on that too because I have less risk over it. But anyway, yes, absolutely. Abso-freaking-lutely. All right. KQQQ is also slept on. Yes. Curve deserves more praise for their handling of the NAV. Yes, they do. And but if you guys want to be more like Curve, I'll give you some advice with your own covered call funds. All they're doing to do so well on the NAV is they're using monthly options. And I know those aren't as fun, but they're steadier. You make less yield, but you have more upside. You go further out of the money and stuff. I'll show you guys in the back tester someday how that works. I'll prove it to you. I'm not just saying that. It's true, though. That's why Any of these ones that do monthly options, they have less risk, less yield, more upside, or better NAV performance, not necessarily better total return. NAV performance and total return are not always the same thing, but good NAV performance definitely hurts total return. Oh, I'm not sharing the screen. Okay, well, thank you. That's all right. I'm not going to get upset today, but I appreciate you for telling me. Anyway, hey, Michael, I was talking about you last night. I was talking about you on, I did a late night live stream. I did a late night with Max and Jax like at midnight. And I'm trying to think, but I pre-recorded it or something. So, and then I forgot to hit the button where it goes as a premiere and I could sit there and chat with you guys, but it was so boring. I talked for like 5 or 10 minutes and then just quit. I mean, without anyone to interact with, it's not as fun. I like to hear from you guys as much as, or hopefully more that you guys like to hear it from me. I mean, I get a lot of information from you guys. All right. So yeah. And you told me I wasn't sharing the screen. Mar, I'm sorry. I didn't read it. I appreciate you though. All right. So now let's get, I really didn't show you anything that interesting. I mean, the stuff we were looking at, we were looking at my model portfolio. You guys got the idea. Okay. So you might want to see a chart though. We'll show you the charts. The first thing I was just showing is all these gaps. And I was just showing how that just makes the order flow so bullish when you have gaps underneath you, especially multiple gaps that are open multiple days. We just created a new one today. Then we had one a few days ago, or we had a new one today. Then we had one a few days ago, one the day before, a few days before that. I mean, we have buyers interested all over the map down here. Even if it pulls back, I would suspect to 575, I would suspect there'd be buyers there. So, it's a positive order flow time to be involved in the market. Okay. Well, and also I'm glad but for the more complex stuff, I do want to share the screen. So I'm glad I'm sharing the screen now. I wanted to talk about, I just want to talk about the back tester for a second. All right. I probably just lost half the people. I got 8 of you guys right now. I'm glad you're here, Michael. Like I say, I won't do any more live streams without late at night. Like I say, I was hoping to talk to you, and I just don't know. It's been so long since I've done one, I forgot how to do it where I can be there and chat live. So it just went. All right, so this is really cool, guys. The main thing I'm not going to try to bore you to death. I'll do that some other day, but I just want to make this point. I'm trying to think which window I was making it in. Where's my incognito window? New tab, drip return. Did I close my incognito window down? Is that it? Yeah, there it is. That's my incognito, right? Anyway, I had a test all set up to show you guys. But okay, but the gist of my thing is the new back tester is scary accurate. I get excited about a lot of stuff, but the old back tester, one of the first things I did was I got in there and I punched in triple QY strategy. And I punched in selling. What they do is it's 60 delta. The Jays confirmed that to me. They sell the 60 delta every day. So it's extremely easy to back test. A 50 delta is at the money. So 60 delta is one strike in the money. Remember, because these are puts. So in the money is above the market. And that's how these guys get a little upside when they do. Well, anyway, I tested it. I tested it like for a year, and this shows the exact trades and everything. It should be right on. But for some reason, Jay was performing a lot worse. The back tester was showing that Jay should have been up 5 or 10 more percent or something. And so then I started to think, okay, well, there's obviously, then I started to think that the fact that the market makers know what trade Jay's going to do every day, they adjust to it, and there's no edge in it. Well, no, that's not the case. I ran a back test today, and it almost came out to the penny. So they fixed this thing. And so, but that's really good, because that means that is really good. That I didn't have as much confidence in the last one. And once I figured that out, even though I used it myself to test stuff, I stopped making as much content on it because I was going to make content and show like, for instance, how triple QI would have done during 2020. We can know exactly to the penny. But then when I couldn't even backtest it over the past year and get a number that was anywhere close, I didn't make any content on testing it over 2020 because, it'd be inaccurate. And it's even worse. It's the worst kind of inaccurate because it's overstating the results. I darn sure didn't want anyone to, to be too bullish. I'd rather you be too bearish and too bullish, right? So anyway, so let's look at this. So here's what I wanted. I'm going to have to recreate it real quick, but we're going to go to backtest. Remember, if you're trying to do this yourself and it doesn't work, use it in incognito mode. So we're going to sell one contract, and nowadays you could either do delta or percentage out of the money. And it's easier for a lot of people to think about percentage out of the money rather than delta, even though it's the same thing. But so also I'm going to start teaching, and when I'm making content, sometimes I'll start using percentage out of the money to try to instruct better and stuff like that to make it more, easier to understand. But anyway, for this case, since Jay told us he sold the 60 delta, we're gonna use that. So it's 0 DTEs, okay. We'll go for the past 12 months. Let's check this out. Just make sure I have everything set right. Yeah. Okay, so look at this. Jay's up a quarter point, total return over the past 12 months. Now let's see exactly, let's look at the logs. We can look at every trade. I mean, this should be right on. It should be just right. That's why as soon as that other one was off by so much, especially overstating it, I kind of soured on it. In fact, I almost wrote Tom Sosnoff a letter bitching about it. And I was going to use that as an example, how you could compare strategies that funds do, and it's nowhere close, but I never did. So the thing is, it says it tests for the last year, but it can't do it can only get to like a week ago. So this is June 20th. So it's the past year through June 20th, right? Okay. Because I had to adjust this. Because if I just do it a calendar year, June 26th through June 26th, this was still off. Not by much, but just off by a little bit. Here, I'm just going to show that to you. And the reason is because we've been melting up the past week. I mean, we're in a better situation. Okay, so, well, let's see here. Now it says doing it this way. Doing it this way, WDT should be up 1.67. Now, what did we get though? Okay, we didn't do quite as well, but that's because the market's been up the past week. Now watch this. Let's take the drip calculator down here to the 18th or whenever it was, 19th. I mean, the last trade they made on the 18th closed on the 20th or closed on, just use the 19th. Anyway, it's right on the money. It's to the penny. I mean, look at that, 75 basis points and 10.35. I mean, that's close enough for me to call it right on the money. I mean, that's 75 basis points. Look at that. And that's annualized, so it's really 74 basis points. But in 10.5, I mean, are you freaking kidding me? That's wonderful. So especially now that I know that the benchmark is exactly right, because it has to be right, because there's no option. So it can't, there's less room for error in there. But yeah, so this thing, so now, so that's great. So all this is telling us is we can test these things, and it should give us exactly the results that not just this one, but any of them that are mechanical, and we should have very close results. I can try to prove this with some other strategies also. We can look at some other mechanical strategies. We can look at we can look at NDX or whatever. But anyway, I was just extremely happy that this started working again. So, and I have more content planned on this. But anyway, I just want to show you guys that this is extremely accurate. If you want to test it yourself, use incognito mode. But I mean, yeah, look at this. So the real one, well, okay, that one's not the real one because that one just goes through oh no, that one is the real one. Yeah. So the market was 10.51 and what was this? 10. That's exactly to the day. Okay. That is it. Oh my gosh. You guys don't know how happy that makes me. That's just, that's everything. That is incredible. All right. So be expected to see more backtesting content. But anyway, I'll try not to make it boring. I'm trying to teach the theory of options, but I try to prove stuff I say with the backtester. Like I'm going to show I think the first video I'm going to make, I'm going to show you how you could sell options 1% out of the money or 1% out of the money, which is about what triple QI does or whatever. Sell options or 1% in the money. Okay. On a naked put, that's the same thing as a covered call strategy with 1% out of the money. Anyway, if you do either of those strategies, you get more upside than, here, let me show you. Than if you sold an at the money option. We know that by watching QILD, but you could see it in the backtester. You do an at the money strategy and it has less return compared to the benchmark. And you do a strategy where you go out of the money 1% or 2%. We can go out of the money. Here, let's do this. Let me show you this. Then you can go out of the money so far that it doesn't make much sense either, where your premium's so small, but your outliers are way too big. Check this out. Okay, so that is 60 delta. Let's use percent out of the money. And this is a little bit confusing to me. But you could also do premium. Here's a better way to do it. Wonder if we just went, wonder if we said, I want to make, what is this? This SPX. Wonder if we said, I want to make $250 a day. Okay. And we're going to sell the $250 worth of premium because that's what we need to live off. In fact, $250 a day is what, 75, 80,000 a year or something. So yeah, that would work. Heck, I want to make six figures. Let's do this. All right. Let's do this. Easy peasy. That's all we got to do. All right. Well, look at this. Look at this. We got 7% return where the index got 11.3. We got about 65, 70% of the upside. Much better than the last test we ran. Right? Or yeah, much better. We only got 1/10 of the upside in the last test. We got a point in the index got 10 points, right? 10 or 11. So yeah. My point is though, if you go, this is super far out of the money. The reason people don't do this is yes, congratulations, you got that, but your yield's really pathetic. It says, oh shit, well maybe not. Average premium. Oh yeah, 32,000. Because I always get confused because these are puts and not calls. Let me go back here. Oh, you sell, okay, that's right. You sell a put and you only want $325. You have to go out of the money. You have to go actually out of the money. Okay, the example's not going to work. Do this. Watch this. Let's do a cover call. Let's get the SPY out. And we're going to sell a call. And we're going to add the stock leg add 100 shares of the SPY. Okay. And we're going to sell a call. Now, same example. Sorry about that. Let's say we want to make $325 a day covered calls. So we want to go as far out of the money as possible. The put example was different because we're going out of the money the other way. Anyway, so we're going to make $325 a day. All right. Well, let's see what happens. So we have 100 shares of stock and then we sold the call, but really that's not much. What I'm trying to show you is that's not much premium. So you're going to get a lot of upside, but if we go for more premium, it's going to steal your upside. Yeah. Look at that. But that doesn't look bad. I mean, well, there's something wrong with that test. I'm pretty sure that's not the way it works. I'm pretty sure they aren't up 7,000%. All right. So what did I do wrong here? Let's look at the details. Jeez. Well, this is the GOAT spread. Let's do this. Let's do this spread. Gosh darn it. let's see what the heck they're doing here. All right, transactions. Let's go to a recent. The trick is to go to the most recent transaction because it's going to be where the SPY is trading around, and we can kind of get an idea where what it's been trying to do recently. Okay. Okay. So, okay. Buy to open. We bought the share. We got our shares takeaway. So we had to buy new shares at 598 on the 18th. Okay. Then we sold the 275 call. Well, something's jacked up with this because, oh no, something's jacked up with this. I'll figure it out later. I mean, I'll figure it out before we figure it out. Anyway, hey, what's up, SB? But regardless, I don't. It's an operator problem. What's wrong with it? I have it punched in the wrong way or something. When it's something easy like selling that put every day, like Defiance does, it's right on the money. Right on the money. So that's really good. I heard of Bitcoin God. I call that Bitcoin God. Yes, I have heard of that. That is very interesting. There's something else I've heard of that I've told you guys about that I can't find anymore, and it has something to do with Bitcoin. I'm going to tell you about it in a second. Let's look at this one first. Maybe it's no, it's not this one. This one is just using leverage, and they give you Bitcoin and gold at the same time. 100% of each, so it's risky. It's double levered, but the idea is the gold maybe could hedge some of the Bitcoin. I mean, I don't know. Anymore, it seems like Bitcoin moves with risk assets, which are stocks, and gold does hedge stocks. So, I guess that's the idea. But anyway, yeah, this thing's real interesting. No dividend. That's why it's not in the tester. But yeah, heck yeah. Okay, get this. What was the one? There was one where they had it was one of these funds where they use like a moving average or some kind of indicator, and they go long Bitcoin and Ether. The thing was they go long Bitcoin and Ether options whenever it's risk on. I forget what their indicator for risk on was. And then whenever it's risk off, they go back to T-bills. And I reviewed them last December. I haven't gone through my old videos and tried to find it. But I was just trying to find them the other day, and I could not remember what name it is. Anyway, I thought maybe you guys might know that one. But yeah, I definitely have heard of Bitcoin God. It's a good one. Yeah, you buy it at 575. I imagine. I don't know what's going on with that back tester. I need to watch it does. I think it does so much stuff, and I'm punching it in wrong or backwards or something. Maybe I'll email Tom and gripe about it or something. All right, what else do we have to look at? What else do you guys want to look at? I want to do this. I want to talk about stuff we were talking about in Discord. I want to try to reiterate some of these points, maybe. Oh, yes. Okay. We're just talking lightning spread, blocks. So here's the big discussion in Discord this morning. Where did this come from? This round? Oh, that's the fund of funds. Okay. The big discussion this morning was that Defiance is coming out with a new fund it's a target fund. So there is no more triple QI just like the one we tested where they sell a naked option. No, there'll be no more of that. I was just pushing back. Defiance is saying it's going to get full upside. But I'll show it isn't. And I can prove it. And as soon as I get the back tester working, we'll run test on it 5 ways to Friday. And I'll show you guys. It's not going to get full upside. I mean, I don't care if they say that, but I don't want you guys to think that. Maybe because they don't say that on YieldMax, on YMax. And YMax does the same strategy that the new proposed Defiance fund does, with the exception of Defiance actually owns the stock and then sells a call spread. The other one owns a synthetic and sells a call spread. But mathematically, there's no difference. That does not make a difference. It's not it. I mean, I could show that in the back tester too. In fact, I will. Well, yeah, that'd be easy to show in the back tester. It's no different. Like I say, if anything, really the synthetic way of doing it is preferable when you're trying to do a gravy train situation. Anyway, but yeah, so we've been debating that all day long. But then somebody said, well, I don't know, but anyway, you guys have been talking with me all day. You probably remember what it is. But anyway, does anyone remember what the name of that fund was that that switches back and forth? There's another fund that switches and different assets though, and I'm trying to think of the name of that fund because maybe it's the same parent company that does both of them. But it's Roro and JoJo. That's exactly what it is. But I don't know if that's the parent company for this one. Roro and JoJo are the same strategy, a switching strategy based on an external factor. So what's the name of this company? Target Date or ATAC Funds. I think it's it. It's ATAC Funds. This Bitcoin one is ATAC Funds. I just figured it out, I believe. ATAC Funds, and it was called Connections Not Private. What the heck? You gotta be freaking kidding me. This freaking Yahoo sucks so bad. I mean, it's because I would search from Yahoo because Yahoo's taken over this freaking browser. Come on. ATAC ETFs. ATAC Funds. See, no problem. Man, Yahoo is just, Yahoo's like the mainstream media or the Democrats. Like I say, and I'm just joking. I'm sure a lot of you guys are Democrats. My mom's a Democrat. My dad's a Democrat. Everyone I know is a Democrat. In Oklahoma, we have conservative Democrats called Dixiecrats. My dad's definitely not in favor of gender ideology and all that stuff, but he's liberal-minded. Anyway, all right. So let me think of the name of this fund, though. But yeah, I do think it's ATA. Oh, it is doing it. Well, that is ridiculous. All right. Well, maybe it's not Yahoo. I'm just going to go anyway. I don't care. Tactical risk on, risk off. Yeah, ATAC. Okay. So like alpha from tactical. Is it ATCX? That's not it. So I don't know. It's another company, but there's some fund out there that's long Bitcoin and Ethereum and then long T-bills. So and I told you guys about it, and I think it might be a good one for a Bitcoin maximalist or, a Bitcoin brother, a Bitcoin bro. But yeah, KQQQ is slept on. Should we, let's go over to the high yield database and let's maybe look at KQQQ, see if it's on there. And if it isn't, maybe we can add it. All right. Like I always say, I need a search function or something. And I know I could sort and just get all the Ks together, but for another reason, I don't want to do that right now. I'm just going to say it's not on there. I would have noticed it. So, look, I put IVVW on last night and I put IVVM on last night. So those are from ProShares, right? iShares, which is BlackRock. Yeah. So let's get us some TQQQ in there, or not TQQQ, KQQQ. KQQQ. Enter. All right, hasn't been around a year. We're going to have to guess at the risk factor, but it's going to have less. It's an index. It's going to be like 0.6. Look at this. Is that right? Is it? Which one's the Holy Grail? I think that this one, is it really up 70% year to date? Gosh darn, that thing is slept on. And if it is up 70%, like I don't want to sort because it's going to mess something up. This is a 3.6. If I sorted, KQQQ would be 8th, between 7th and 8th. So it would be 8th, 8th would now be 9th. Anyway, sorry I missed that in there. Do you guys catch anything else I'm missing? Look at old S-put doing well. That's good. I don't think I have S-bar in here, but that's right. It's too new. Coney, all these look good. I really like this one. This one doesn't pay much yield, but they only do a half overwrite. And they own the Qs, so you get tons of upside. I guess the Qs are up 5.9% this quarter because there's that number right there. So it's pretty good. 5.9% for a quarter. I take 5.9% every quarter. You know, it's, what is that, 24% a year? So that means you double your money every 3.5 years. It's not too bad. All right. Well, I think we're getting closer to having all the ones on here. We even put WEEI. We have KQQQ, IVVW, IVNW. Let's see how those are doing. Why are these such dogs? I mean, they don't pay much dividend. Well, actually they do. This one pays 20%. It's paid 8% over. Maybe it hadn't been around a year yet. There's no way. That's a 12%er. We're going to have to check that out, though. We are going to have to check that out. And this is exactly what I'm trying to avoid having to do. Open a new tab, go to FinViz, check stuff out every time. But for now, IVVW. I was right about iShares. iShares is owned by, I forget who the parent company is. IVVW. Sorry I wasn't sharing the screen at the first, but you guys don't care. You're used to it, I should say. Thanks for sticking around. I know that Tom's fishing today because he would have emailed me if he was watching live, or not email. He would have shot me a text, but I bet he's fishing or out probably maybe taking his wife to lunch or dinner or doing something fun out there in New Jersey. I forget what I was going to show with this. Oh, yeah, IVVW. So is this really paying 20%? Yeah, 17.79%. Okay, I take back all the bad stuff I said about this one. But on the other hand, though, look at how bad the total return is. Why is the total return bad, you ask? It's because the yield's better. You can take less yield and get better total return, or better NAV return for sure you can get, or the opposite. I mean, people are buying the heck out of this. 300% inflows this month. I mean, it's a good source it looks like a good source for yield. Because 17% from a big company. Let's look at it. Maybe this has been around for a while. Let's look at a weekly chart and see when this came out. I don't think SPY Eyes or I have SPY Eye. Is iSpy on the map? Is iSpy in the? I don't think I've seen iSpy lately. But yeah, here's the problem with this one. Okay, so you have more over here, 17.79%, where, normal one, JP Morgan, that Global X, they get 12, 8, 10, for the same type of strategy. Okay, well, these guys are paying you 17. Well, okay, it comes out of your performance for the quarter. Like I always say, it's your money. You get to decide how you want to be paid back. You had to work your whole life to save up the $500,000 or the $1 million or whatever you have saved up, 2 million, 5 million, whatever. That represents an entire life's worth of work and inheritance in my case, or whatever. And investments, it represents the entire thing. So it's your money. You worked hard for it, You work every day at 8:30, so you can decide, I'm going to invest in a fund that's going to pay me back with a higher yield, or I can invest in a fund that's going to pay me back with no more NAV return. And that's why by default, I always say younger guys go with the more NAV return, because you can compound that free, people understand that. And older guys that need a little income, sometimes there's sacrifices you have to make. Just put it this way, ask yourself, how many high yielders would you have if you didn't need income? I mean, I might still have them anyway because I'm fascinated with options, but I mean, there might be tactical uses for them. I mean, you might still have them anyway, but seriously, these wouldn't be too popular if they didn't pay a yield, right? I mean, or let's just say for whatever reason you didn't need income. That's why I always give the example, if I had $100 million or $1 billion or whatever, if I was in the situation where I didn't need income, once you get to the level of over 5 or 10, you guys know what I mean. It just money, the way it works. If I was in, that situation, but for sure by the time you get the higher numbers, I mean, let's think on 100 million. And now the other thing is, it doesn't cost any more. If I have 100 million and you have $1 million, it doesn't cost any more for me to live. If I want to buy a Lambo and have a trophy wife and a cocaine habit, it might cost more, but it doesn't cost any more to live. So if I had 100 million, I said the other day I would just get 1/10 of 1% of the high yield funds, but no, I'd get 1%. But $1 million in the high yield funds, you'd still get plenty of upside. I'd have 99% upside. That in the average on my, and I'd have the model portfolio just like I'm doing for my brother-in-law. That thing averages about 20%, 200,000 a year. That's about in my opinion, that's a pretty nice living, but let's say a guy has 5 million. That's also quite an accomplishment. He could use the 20% method, which would give him 800,000 in these funds. Still have 80% unlimited upside or whatever the other stuff he's invested in, stocks, bonds, whatever, and be making 8 times 20, about 160,000, just like me, making a 6-figure income passively. But the income's why we do these things. The income's why I do them. Let's look at Round Hill's. No, yeah. Let's look at Round Hill's new growth in income tickers. All right. What I hate most about politics is anyone that I'm just not honestly, I vote for the man. There's been times when I voted for the liberal candidate or something, or not very often, but it's not about the party they belong to. It's about the ideas that you agree with. Generally, you agree with the ideas of the same people in your party, but not always. All right. What were we going to look at next? Oh yeah, the Round Hills. So let's just type it in. I forget the things, but we can look right here. Weekly pay. So there they are. There's these weekly pays right here, right? They're like it's this one. It's the C. It's the one with the W's. Yeah, COIW. Okay, let's compare COIW to CONY. And even before we compare, we probably know how they are going to. Holy cow! Look at that. Well, it's because of Coinbase. But how'd they get all that upside? It's because they don't. It's because they have swaps, but the swaps doesn't give them extra upside. You're still capped. But I was trying to look down here and see what strike they had, but there's no strike. Oh, here's the thing. Well, it's weekly pay. I thought maybe it was a weekly expiration swap, because a weekly expiration would definitely get you more upside than a daily, just like a monthly expiration gets you more upside than a daily or a weekly. But anyway, these are doing pretty well. Look at this, 11%, and I'd say that's a third of a year. So looks like 30% plus is doing all right. So let's do a little comparison. But I'm going to say right now, because I know Coney earns about twice that much, that Coney's NAV is going to be worse. This one's NAV is going to be better, just without knowing anything else. That the swap, the non-swap, having real stocks, having a synthetic, that doesn't matter near as much as these other factors. All right, so let's just test these. Gosh darn it. Every time I hate opening this one, and then I can never find it. And did I close it already? So yeah, gosh darn it. If I had $1 for every time I open freaking dividend channel, or hang on, or the other one, maybe I would have 100 million. Gosh darn it, I already forgot we're looking at. Oh yeah, Coney and COIW. All right. Well, so was I right or wrong? I was right, of course. Coney had more upside. You look at more NAV. It's incorrect to say more total return. It's more NAV return. Sometimes leads to more total return, but let's see if that's even correct. So they went from 48 to 55, while Coney itself went from 11 to 10. That's not bad either. Or 11 and a half to 10, basically 10. Not too bad at all. It's down, NAV's down 20%, but it paid but what does it pay? It pays probably an 80% yield for the year, but NAV was down 10% for a third of a year. So the NAV would be down 30% if it paid it. It projects a yield of or a return of about 50%. Now this one's making a return with 26% in a third of a year, total return of 26%. Yeah, if you like upside, sure. These are better, but it's not because I just want to try to get through everyone's head. It's not because of the swap. It's not because one uses stock and the other one doesn't use stock. It's because you can just look at the yield. I mean, those other things may be a factor, but when one pays a double yield, that's all you got to know. Because the reason you do know that is because there's no free money. Anyway, but yeah, thanks for having me look at that. So nice, and they're going to make it easier to own when they're weekly. Yes, when the weekly fund of funds. I'll commit now to putting the weekly fund of funds in the model portfolio because I am definitely round hill curious. I've always been round hill curious. So I'm just scared of the downside. And the Defiance ones have twice the downside buffer because they have twice the yield, but they get half the upside for the same reason. Just using round numbers, right? So let's go look at a couple of others. Let's do the APPW or let's do the other one. So what are the other ones called? I think there is a AAPW, and we'll do Apple and Amazon and AMZW. Okay, so let's do this. But do you think these will work out the same way? I bet they do. Better NAV, better total return, most likely. Worse, other stuff. Okay, yeah, it's sure enough. The one that pays a higher yield, guess what? You get a better buffer on the downside, don't you? And we can easily see that here. 15% instead of 22%. That's a 50% difference. Well, what the heck? Well, look at this. It paid $1.61 in a third of a year. Multiply $1.60 times 3. What is that? That's 4. That's $4.80. We'll call it $5. $5 on the $16 investment. It's just about 30%. Okay. Now I bet you this one comes to about half of that, or about 50% less. And look, and they also have 50% less upside. So so let's see. This one paid $3.73. We'll times that by 3. So that's like $11 on 50. So that is like 20%. It's 50% less than 30%. They have 50% less upside. It's just math. It is just math, right? Now let's look at Amazon. Like I say, it's your money. You can decide. You earned it. You can decide how you want to be paid back. I guess maybe that's the part I'm happy about. I said these were going to change the way people retire. Maybe I was overly optimistic, but you don't have to go see an insurance guy to get an annuity anymore. You can self-annuitize your own retirement. I think that's cool. Not to mention, like I say, I was always going to sell covered calls anyway, in retirement. So, I mean, this is selling covered calls. Anyway, okay, so Amazon, so look at this one. Now, let's look at yield first, or well, not Amazon, gosh darn it, AMZ. All right, so what are we going to say? Oh, not AMZ, it's what's it, AMZW? Yeah. Okay, well, it's not old enough. Is that really what the ticker is? That doesn't sound right. And it is, AMZW, okay. Is Berkshire too new? How old is Berkshire? It's like brand new also, isn't it? Because we could test this one against the YieldMax one. Yeah, it's too new. What about NV? I think NVDW has been around for longer. Let's do NVDW against NVDY. It's just to try to see if my point is the same. If that's the same relationship that we're expecting. So we will just check that. All right, so we'll put NVDY up here and NVDW down here. Okay, so now this one's close. It's close. NVDW does have triple the, it looks close on here, but it's triple. Look at that. They made 14% total return over about a quarter, where NVDY made 5%. Okay. Now, to be fair, NVDY pays a much higher dividend, I bet. We'll add it up. I bet it pays, twice the dividend. So let's see. That's $16. And 16 out of something that costs you $21 to buy, that's 3/4. That's 75%, roughly, wouldn't you say? And so this one right here, we multiply dividends by 3 to annualize it. So that comes out to 17. So $17 on 50 is 25%. So one paid 75, one paid 25. If you think about that, that's the same relationship to this one had twice as much upside, but only earned a third as much. It's the same relationship. Now, I don't think it works out that way every time perfectly, but it's that you could see the math is really working well today. You guys probably have that down. I need to quit emphasizing that so much, but hopefully there's new people who are watching that think these things are magic and they watch that and it clicks. Oh shit. So you mean if I take extra yield, I get more risk. So I do worse on the upside, but better on the downside. It's kind of a weird thing to wrap your head around, but once you wrap your head around it. One last one. Yeah, sure. Let's look at FIRI. So what are we going to test it against? Well, it's an income fund. So let's test it against, you guys give me the name of a good income fund, or if a good, like a safe fund that pays about the same yield. Maybe like I want to say maybe like a THTA. That's supposed to be an income fund that's like a bond. Now I know people hate that, but it pays 12%. The FIRE thing pays 12%. Let's just compare these two. Okay, well, THTA had a little bit of a problem. That's why we don't do covered calls. But let's compare FIRI with Cashy. Isn't that something that does something similar, or Bondi or something, or TLTY does? But okay, so because in other words, I'm trying to find other stuff that makes 12%. So here we have Cashy making. Does it really make 12%? Let's see. It's half a year and it's making $1.50. So that's 3. That's about 15%, which isn't bad. Well, it makes 12 actually. I rounded up. Okay. So it makes 12. So this one makes, it's about the same. It is the same because, well, no, it's not. It's not the same. Cashy makes about 6%. Yeah, and that makes sense because it has better total return, right? I don't even have to really calculate it. I should have just looked at this and I would have known to be expecting less total return out of Cashy. Now let's compare FIRI to Bondi. What's something else that pays 12%? I guess we could compare it to like QYLD, because if you're just after 12%, you don't care what it comes from, right? Now it's not fixed income. I was trying to think of a fixed income based investment that pays 12%. But all right, FIRI. That makes it look pretty good right there. But that's not really a fair comparison because QYLD uses stocks. Stocks are way more risky than bonds, so that's not a great comparison. But yeah, I'm liking FIRI. The more I take a look at it, it just. We could compare it to longer term bonds, but I think these are also too volatile. We could look at TLTW. The return's roughly the same. Well, What does TLTW pay? I should know, but I forgot. It pays 12%, doesn't it? So that would be about 450 on 24. Now it pays a little bit more than 12%. That's right. It does pay more than 12%. Well, I mean, you could see if you got TLTW, you have a lot more exposure to risk. The fire thing is super safe, which is, that's pretty good when you're looking for income. So yeah, I like that fund. I like that fund a lot. I was the first person to cover it on my station too. I was the first influencer to cover it. Yeah, SPY INT SPY. Okay, good idea. Good idea. Even though SPY is great and stuff, you're going to see it's way more volatile than FIRI. It outperformed it, but I mean, after it dropped 13% when the other thing was barely unchanged. So, it's like I say, it's your money. You get to decide how you want it back. Let's do a little T-SPY. Now, T-SPY also pays more than 12. Don't they pay 14 or 15? I think they try to edge it up a little bit. And that would make sense because they have less total return here. So, yes, I'm going to say I bet they do pay more than FIRI just based on that alone. Now, let's see here. Okay, this is easy math. It's $2.06 of a year. So that's like $3.60 on something that initially cost you $25 is about 15%. So, and this is about 12%. So no. So T-SPY does pay a little bit higher yield. So I can excuse it for having a little bit less total return. But it also has one heck of a lot more risk compared to these covered call funds. All right, guys. Well, what else you want to talk about? Anything? I see I'm out of Cokes. I don't even have an empty one anywhere, or, a partially empty one. All right, guys. Well, I think it's been a good day. We talked about some good stuff in Discord. It's been a good day trading. I think all of you guys it seems like you guys, the trades I'm hearing about anyway, are working out pretty well. So I'm happy for you guys. I will, sorry about the bust in the content I'm telling you guys, when you see my new content I'm producing with the back tester working, it's going to be fire. It's going to be incredible. It's going to be the best video I've ever made. But for whatever reason, it wasn't working. But I promise, give me another chance on the back tester. All right, guys. I appreciate each and one of you guys, and I will talk to you later. See ya.